Hi, I'm Jimmy. In this video, we're going to look at General Electric and try to determine if we believe that GE stock is a good buy right now. So General Electric stock has had an interesting time in the past few years. This is a 5-year chart, and as we can see, it hasn't looked too good for them. So what has happened to General Electric? Well, I did a video on GE about a year ago right there, and back then the stock was trading at about $13, $14 a share. My hesitation at the time was that it appeared that GE's business was falling apart, and I thought that perhaps the new CEO at that time he wasn't on the right track. He wasn't doing what GE needed him to do. So here's how the whole CEO position is shaken out for GE. Back in 2001, Jeffrey Immelt took over as CEO. That lasted until 2017, where John Flannery took over. About 8 months later is when we did that last video. Well, up until that point, it hadn't been terribly clear what Flannery's plan was for GE. He had some ideas, but it didn't seem terribly clear. The rumor was at the time that GE was going to spin off their oil and gas business, which was part of the Baker Hughes deal, and that didn't end up happening. GE was also expected to spin off their healthcare business, which didn't happen. But what did happen is that GE ended up selling their biopharma business to Danaher. Why is this important? Well, back in September of last year, John Flannery was out, and who stepped in? Larry Culp. Larry Culp stepped in as the new CEO. Where did he come from? Danaher. Well, shortly after Culp gets over to General Electric, he goes ahead and sets up this deal with Danaher. And in February of this year, GE announced that they were selling their biopharma business for a bit over $21 billion in cash, and it's expected to close, I think, towards the end of 2019. Now, I think that this sale, in addition to a few other sales that GE has executed, are going to be a good thing in the long run for General Electric as a business. And ultimately, I think that this will be a good thing for GE stock. So, why, you ask? Well, really, the big problem for GE is their balance sheet. They have a ton of debt. To illustrate, this is a chart of GE's debt compared to their own market cap. And as we can see, the market cap of GE is less than their current level of debt. When we compare that to a company like Danaher, which is where Larry Culp came from, well, this is their market cap and this is their debt. So clearly, GE needs to do something to clean up, to strengthen their balance sheet. And I think that that's one of the reasons that Culp is a decent CEO. He's a big fan of cash, and he's a big fan of a strong balance sheet, and he's made that known since he got to GE. Okay, now let's look at some of the business lines that they have. So this is a chart of their various segments as of 2018 revenue. And as we can see, their largest segment is aviation. I'm going to focus mostly on just the largest segments. So right now we'll focus on aviation. Now this is one of GE's best performing businesses. In the first quarter of 2019, well, they put up organic growth in the 12% range, and they had margins of 20 to 21%. And this has long been a solid part of GE's business plan. They've dominated the aviation industry for a long time. But at the end of last month, Raytheon announced a merger with United Technologies. And ultimately, this is a very big deal. It has the potential to be a very big deal for this business line. Now, this is an important thing for GE stock because ultimately the cash flow that Raytheon and United Technologies will bring together, by the way, they're going to call it Raytheon Technologies, well, together, the cash flow that they're going to have could potentially allow them to go after the airplane engine market that GE has dominated for a long time. And if they do that, that could potentially be a huge contender that GE has to deal with. Now, that deal is not expected to close until the same time next year, but I bring it up because I think it's something that we should watch because this is an important part of GE's long-term business. Okay, now moving over to the power segment. On one hand, the power segment is facing threats from renewable energies like wind. But luckily, GE is also focused in the wind area as well. So they're really going after the energy market from two fronts. The power segment put up about $27 billion in revenue. The renewable energy segment put up about $9.5 billion in revenue. Right now, the power segment has negative free cash flow thanks to a very competitive market. And according to GE's management, well, they've come out and said that they expect for the free cash flow and the revenue to drastically improve over the next few years. And this is an important thing. Now, one of the things that they're doing in the power segment is they're trying to restructure it. They're breaking it up into two segments, I believe. They closed down the power segment's headquarters to try to save costs. That way, they're trying to improve the margins of the business. But this could be a long play. This could take a few years. Okay, now we jump over to healthcare. Now, As I mentioned a moment ago, GE is selling their biopharma segment to Danaher. The biopharma business was part of GE Healthcare. So obviously, we can expect this piece of the pie to drastically reduce once they complete the sale at the end of this year. Now, healthcare and aviation have been two of GE's strongest segments for the past couple of years. So yes, they are getting a ton of cash from the sale to Danaher, but at the end of the day, they're giving up a decent business as well. Now, I've also read that GE is selling off a part of their Baker Hughes, which is in the oil and gas segment, their Baker Hughes ownership. They're selling that off. And ultimately, at the end of the day, I think this is a very good thing because they could use the cash. And the oil and gas business is very difficult, a lot like the power business. It's highly competitive, and oil hasn't done quite what the organization has expected ever since they acquired Baker Hughes a few years ago. Oil's really been somewhat volatile, but the prices have not gotten impressively high. Okay, so now we're going to look at the long-term plan for GE, and then we'll take a quick stab at trying to value GE stock. So GE has made it clear that their goal is to get rid of some of their debt, improve their credit rating, and streamline their business, make it as efficient as possible. Now, as far as the debt is concerned, I think it makes sense to get rid of some of the debt and ultimately improve the balance sheet. In doing that, they will also improve their credit rating, but it's not going to be that fast, and it's possible that their credit rating gets worse. To illustrate what I mean, well, this is a history of GE's credit rating according to Moody's. Now, ultimately, what this means, to make it a bit easier to see, this right here, this is Moody's credit rating scale. So often, the top half is considered investment grade. The bottom half is non-investment grade, often called junk bonds. In theory, the higher we get to the top, the better the deal you would get whenever you were issuing new debt. Well, starting back in 1994, General Electric's credit rating was AAA. That's the best rating there is. But then, back in 2009, their outlook was shifted by Moody's to negative, which basically means that they're still AAA, but there's some warning signs that things might get downgraded from here. Well, just 2 months later, GE was downgraded all the way down to AA2. Well, this trend happened quite a few times over the past decade, with a handful of downgrades and a handful of shifts to a negative outlook. Red is a negative outlook, purple is an actual downgrade. Well, then in 2018, they got downgraded to their lowest level yet, Baa1. And ultimately, this is important because if this continues to slide, it's going to make cleaning up the balance sheet all the tougher. Right now, as revenue has grown a little bit, margins have been somewhat squeezed, specifically by some of their businesses. If that continues to hurt them and a credit rating agency were to reduce their credit rating further, that's going to make it even tougher for them to get out of the hole that they're in. Now, this brings us to an outlook for GE stock. So at the end of the day, in the last video that I did, I said that I thought it made sense to avoid GE stock. And I used the old saying that a lot of people use on Wall Street. And the saying goes, don't try to catch a falling knife. Well, if we were to shorten this chart up to a 1-year chart, well, here we can see that GE appears to be stabilizing a bit. And I think that there seems to be at least some new confidence in the plan that GE is now laying out under Larry Culp. So what do we think GE stock is worth today? So at this point, I'm not sure the metaphor of a falling knife still applies. I think that it's unlikely that huge bombs are likely to be dropped from GE as far as news that shocks Wall Street. I would expect for continued sales of some assets, perhaps some acquisitions of some strategic assets. But at the end of the day, what do we think GE stock is worth? So by all accounts, it's going to take a long time for GE to clean up their balance sheet, clean up their business, improve their margins, things along those lines. But at the end of the day, let's imagine that they do go ahead and execute their plan. They improve their margins, clean up the balance sheet, streamline the business, they pull off some growth in revenue, and they really start to execute the things that they're saying they're doing more than they have already done. Well, if they do pull it off, I think that it makes sense to look at competitors like Honeywell or 3M. And right now, their forward price to earnings ratio is about 18x. So that 18x is based on next year's earnings per share. And ultimately, if we were to use 18x and analyst expectations of about 73 cents per share in 2020, well, that would mean that the fair value of GE stock would be about $13 per share. Given that GE stock is currently trading about $10 per share, well, that would mean there's about a 30% upside. And I could easily make the case either for this type of fair value calculation or against this type of calculation. For me, there's so many question marks with an investment like this. The one thing that I'm almost certain of is that this could be a great investment if we're in it for the long haul, because it's going to take a long time for this thing to turn around. Now, I wouldn't be surprised if in 2 years, GE stock is sitting at $20 per share because things have gone fairly well. They made a few good moves, and suddenly the market's valuing it up at $20 per share. I also wouldn't be terribly shocked if it stays right around the $10 mark, maybe even $9, if they run into a few hurdles that people haven't expected. That being said, I think that GE stock makes sense for some investors who are willing to sit in it for the long run. Now, they're not a good dividend play. They used to be, not anymore. Right now, their dividend's down to about a penny per share, and that's expected to stay that way because Larry Culp he's notorious for being a lover of cash, and he's going to do whatever he can to hold on to as much cash as possible until the business gets to where it needs to, and then I'm sure the dividend will start flowing. But what do you think? Is GE stock worth buying today? Let me know in the comments below, and hopefully you found this interesting, and if you did, please hit the subscribe button, hit the thumbs up, all that fun stuff. Thank you for sticking with me all the way to the end of the video. I'll see you in the next video. Thanks.